Hello and welcome back to our second video lecture of Chapter 1, which deals with financial accounting and business decisions. In this video, we're going to look at three things. First, we're going to describe the accounting equation. Then we're going to look at each financial statement. And then finally, we're going to look at additional disclosures that a company has to make. Now, when I say company, this is financial accounting. We study GAAP. And if you remember from the prior video, GAAP only applies to corporations that trade on a U.S. stock exchange. So from now going forward, when we say some of the rules that we talk about, some of the reporting aspects that we're going to talk about, really apply to corporations that trade on an exchange, whether that's the New York Stock Exchange, the NASDAQ. Now, you might ask, well, wait a minute, we talked about forms of business in the last video. We talked about partnerships and we talked about sole proprietorships. Do they not follow GAAP? Well, they're supposed to, okay? They're supposed to follow GAAP, but being that the sole proprietorship and the partnership have the advantage or they have a tax advantage, normally they report on a cash basis, okay, for tax purposes. So everything we're looking at here applies to, a major corporation that trades on an exchange. And each quarter, at the end of the year, those corporations that trade on an exchange are required to file their financial statements, okay? So that's what we're going to go over. The accounting equation applies to anybody that does accounting, okay? Regardless if you're a sole proprietorship, if you're a partnership, corporation, they all have the accounting equation. It's the same accounting equation, and the accounting equation, always holds true, okay? Meaning it has to balance. Okay, so the first thing we're going to look at is the balance sheet or statement of financial position. Notice that in the header, well, first of all, we got a lot going on here. Let's pump the brakes here for a second, okay? There's two things, or there's a bunch of things I want you to take note of. First is, by the way, I apologize if you hear my dogs barking. Throughout the next 7 weeks, they will be part of our lectures. Okay, so the first thing I want you to know, or I want you to take note of, is the form. Okay, meaning how is this thing set up, right? So notice on the first part, it has a header. It has the company name. It has the title of the financial statement. In this case, we're looking at the balance sheet. And then underneath it has the date. Okay, now notice here that it says December 31st, 2014. Okay, the point is the balance sheet shows or reports data at a specific point in time. Okay, so I'm going to show my age here, but if you're familiar with a Polaroid picture or a still picture, that's what a balance sheet is. Okay, it shows data at a specific point in time. That's it. Okay. In addition to, or another thing about the form of the balance sheet I want you to take note of, look at what it shows. It shows the assets, it shows the liabilities, and then it shows the stockholders' equity, okay? The balance sheet demonstrates the accounting equation, okay? The accounting equation says that assets, which we see down here, assets always have to equal liabilities plus stockholders' equity, okay? What we do to one side of the equation, we have to do to the other side of the equation. In other words, this equation always has to balance. Now, in Chapter 2, we get into debits and credits, okay? As long as we debit or credit the right account based on the economic activity that happened, the accounting equation will hold, okay? So let's look at assets. What are assets? Well, these are basically resources to the firm, Okay, so what are some examples of assets? Well, we have cash. We have investments. Yes, a company will invest cash in other corporations. Okay, like you and I would, if we have a 401k or a brokerage account with a financial advisor, we would invest in stocks and mutual funds and bonds. Companies do the same thing. Okay. Accounts receivable. This is an asset to the company. Okay. An asset is basically a promise to receive money, or a right to receive money. Let's say right. Okay. Inventory is an example of an asset. We have prepaid expenses. Okay. Prepaid expenses are examples of expenses that we pay in advance. Examples would be prepaid rent, meaning January 1st, we go to our landlord and we say, hey, we want to rent this this office space. Okay, well, it's $1,000 a month. Okay, no problem. I'm going to prepay you for that, meaning I'm going to give you $12,000 right now, and basically my rent is already paid for the entire year. Okay. We'll get into this when we get into accruals. But for right now, what you need to know is that's an asset to the company. Okay, it's a resource, right? After that, we have our PP&E, our property, plant, and equipment, or land, plant, and equipment. Okay, and then we have our total assets. Notice our total assets equal $1,792,209, if I'm reading that correctly. Okay. So we total out our assets. Notice the double bottom border here. That means we are footing this data, okay? Meaning we're making a calculation, we're adding up all the assets, cash, investments, accounts receivable, inventories, prepaid expenses, property, plant, and equipment, any other assets we may have. These are our total assets, okay? This is the left side of the accounting equation. The assets part, that's the total. Okay. Next, we list our liabilities and stockholders' equity. Notice how we have this column here, okay, that states, or let's say it's a row that kind of dictates what's going to come next. Okay, it's kind of like a header. We'll say a header. All right. So we list our liabilities. Well, what are our liabilities? Anything that the company owes, right? It's an obligation of the firm. Okay, I owe somebody money. I owe somebody taxes. I owe somebody payroll or a paycheck. Okay, anything that's payable is an example, or not is an example, is a liability. Okay, so notice what we do here, right? We list our liabilities. Now, liabilities are, if you notice, they're really not liabilities, and assets as well, should always be listed in order of liquidity, meaning the assets. Which asset do we think is going to convert to cash first? Okay, which one of these assets has the most liquidity? Okay, liquidity refers to how easily can I convert it to cash. Same thing with liabilities, right? How are these going to come due? What comes due first? What comes due second? What comes due third? So it's based on, assets are based on liquidity. These liabilities are based on, time of obligation. Okay. Later we'll talk about short-term liabilities and long-term liabilities. But for right now, know that liabilities are any payables. Okay. We have accounts payable. We have income tax payable. We have, other liabilities. Those other liabilities are like our, salaries and wages payable, interest payable. Maybe we have some, long-term debt that is going to be due within the next year. We would lump that portion of long-term debt that's due within the next year as a current liability. Okay. We total up our liabilities. Notice we don't have a double bottom border here, right? Why? Well, because we need to take this total and add it to our stockholders' equity, okay? Within stockholders' equity, we have our common stock. Those are the shares of stock that we sell. And we also have retained earnings, okay? Retained earnings are the earnings that a company keeps, okay? What in the world does that mean, right? Well, think about it. In year one, a company has net income, right? They have two things that they can do with that net income. They can pay it to the owners, or they can retain it in the company to reinvest in the company, right? They can utilize those investing activities, okay? They can use it to pay down debt from those financing activities, okay? Then we total up our stockholders' equity. So from here, we're going to add the total liabilities with the total stockholders' equity, and you notice we have total liabilities and stockholders' equity, okay? Notice that this total, the $1,792,209, matches the total assets, okay? So the balance sheet really, the balance sheet is the accounting equation, right? And it makes sure that the accounting equation balances, okay? So when we're talking about stockholders' equity, basically stockholders' equity are the owners or the stockholders' claims on the assets of the firm, okay? So we have assets. These assets that we have purchased, we have to convert them to cash and either pay our liabilities or pay them out to stockholders' equity, or pay them out to the stockholders rather, okay? So that's the balance sheet. The next thing we're going to look at is the income statement, okay? Well, when we're talking about the income statement, this is a report that shows us the results of a company's operation, okay? Again, notice the form. Notice what we have at the top. We have the company name again. We have the name of the financial statement, which is income statement. And notice the time period. It's for year ended 12/31/2014. For year ended. So what we're saying here is that this financial statement, this income statement, it's not like the balance sheet, okay? We said that the balance sheet is like a Polaroid picture or like a snapshot picture. The income statement is more like a movie, right? It covers a span of time, okay? So we're saying that the income statement reports the results of operation for a given time period, okay? Within the income statement, we have revenues and expenses. So to figure out our net income, we take our revenue or our total revenue and we subtract out our total expenses, okay? So revenues are actually increases in a company's resources, and they get this increase in those resources result from either providing a service or selling a good, okay? Expenses are actually decreases in resources, again, from providing that revenue, okay? So it's very important that we understand these definitions between revenues and expenses, right? I think the majority of you folks coming in like, yeah, I know what revenues are. I know what expenses are. We know it, right? But we kind of got to get that jargon down, right? And we got to see that, okay, well, revenues are basically us earning money or earning resources, whether it's cash or accounts receivable, from our operations, right? From doing business, providing a good or selling a good or providing a service, right? Expenses are actually the decreases in resources that we incur because we provided revenue, right? We had to use inventory to make revenue, okay? Or to earn revenue. We had to recognize an expense, right? We had to pay employees in order to generate this revenue. We had to pay rent in order to generate this revenue. Okay, so that's what we mean when we say expenses are decreases in resources from providing revenue. Okay? The next thing we have is the statement of stockholders' equity, okay? And this basically is very similar to the income statement, right? In fact, we have to complete the income statement before we can prepare the statement of owner's equity, okay? Why? Well, let's think about what the owner's equity statement is, right? This statement reports any increases or decreases in the company's stockholders' equity or in the owner's equity, okay? Because stockholders are owners of a company. So basically what we're reporting here is, hey, how did the equity of the owners change, right? Well, remember, net income actually increases the stockholders' equity or the owner's equity, okay? Notice the form, right? Again, we have company name, great. We have the name of the financial statement, statement of stockholders' equity. Notice we have the time period for the year ended 12/31/2014. So, like the income statement that covers a span of time, so too does the statement of owner's equity. It also covers a span of time, okay? Notice the two parts within the statement of owner's equity. We have additions and we have deductions, okay? So let's look at what increases the owner's equity and what decreases the owner's equity. Well, if we would issue new stock, that would increase the owner's equity account because our owner's equity account is going up. Why? Because we're issuing stock, investors are paying us cash for our stock, that's increasing our equity. Net income also increases owner's equity or owner's capital, okay? What decreases owner's equity? Well, let's say for a moment that there's a bunch of stock floating around out in the market, right? And we as a company don't want that, okay? We want to buy back that stock. We want to repurchase that stock from the owners that have it. They're willing to sell to us and we buy that back. That decreases our owner's capital account, okay? Any distributions that we make to owners also decreases our equity account. What's a distribution to an owner? Well, we pay them dividends, right? Why do people invest in stock? Well, because I either want the stock to increase in value or appreciate, but I also expect that company to pay me dividends, right? Every so often. So repurchasing common stock and dividends are two examples of what decreases our statement of owner's equity, okay? The next thing we have is the cash flow statement, okay? Cash flow statement, again, very, very important for us because it shows us what activities are increasing our cash, what activities are decreasing our cash, okay? So notice the form, right? We have the company name, Columbia Sports Company. We have the name, statement of cash flow. But then notice the time frame it covers. 4-year ended 12/31/2014. So just like the income statement, just like the statement of owner's equity, this statement of cash flow covers a given period, okay? So what the cash flow does is it reports all of our cash inflows, all of our cash outflows during a specified period of time, whether it's a year, a quarter, whatever, okay? There's 3 sections, and if you can notice here, there's 3 sections within the statement of cash flow. We have cash flow from operating activities. We have cash flow from investing activities. And we have cash flow from financing activities, okay? Basically what this statement does is not only does it show us where we're earning cash and where we're spending cash based on the activities, it also proves our cash balance, okay? let me go back just real quick to the balance sheet. Notice what our cash is. Our cash is $413,558, okay? We do the cash flow and we say, okay, based on your operating activities, investing activities, and financing activities, that $413,558, you got X amount from operating activities, you spent X amount in investing activities, and you either got or spent X amount in financing activities, okay? So cash flow from operations, again, that tells us, hey, this is the cash that you either spent or earned on operating, right? Selling goods, providing a service. Cash flow from investing activities, okay? This has to deal with, did we buy or sell any long-term assets? What are long-term assets? Property, plant, and equipment, okay? So what we're saying here is this cash flow from investing activities shows us, or basically at the end of the day, proves of that cash, or how we got that cash balance at the end of the year, $413,558. You got that amount because you either sold some assets and you earned cash from selling assets, or you lost cash because you bought long-term assets, okay? And then finally, we have cash flows from financing activities. Financing activities are where we either issue or repurchase stock, or if we borrow money, right, from creditors or, bondholders or banks, right? So basically what we're saying here is from the financing activities, this shows us where cash came or left based on us either selling or issuing stock, and based on us either borrowing more money or repaying creditors, okay? So all these financial statements are linked together, okay? Here's the order you want to prepare them. First, you want to do the income statement, always, never fails. You always have to do the income statement first. Next, you have to do the statement of owner's equity. Then you do the balance sheet. Then you do the cash flow statement. Well, that's a pretty specific order. How'd you get that? Well, let's think about how these financial statements are related or interrelated, okay? We know that net income impacts the owner's equity, right? So in order to calculate the change in owner's equity, I need to know what my net income is. So what we're saying is net income or net loss flows in to the statement of owner's equity, okay? Once we calculate that ending balance in our shareholders' equity, that amount flows into the balance sheet, okay? So once we do the balance sheet, we can show that, okay, we have our total assets, we have our total liabilities, we have our stockholders' equity, and we know our stockholders' equity is right. Why? Because we know what the change was from our statement of owner's equity, and we know that net income impacted that statement of owner's equity. We can do the balance sheet. Once we have our ending cash balance from the balance sheet, we can then go ahead and calculate our statement of cash flow, okay? This is very important, very important. As we're going through doing the financial statements and once we get into journal entries, it's always important to know that the beginning of one period's balance sheet is the previous period's ending balance. Let me say that a different way, okay? So let's say that we have cash on 12/31/2014, okay? And that cash is, I can't remember what it was, $400,000, okay? How much cash do we have on 1/1/2015? Well, we're starting that period with the $400,000 cash that we had the day before, okay? So basically what I'm saying is one period's ending balance is the next period's beginning balance. Okay, very important. Additional disclosures, right? What does a company have to disclose in addition to the financial statements? Well, if you've ever had the interest, I guess you could say, of looking at a company's annual reports, you'll notice that in addition to the financial statements, they have a section called the MD&A, the Management Discussion and Analysis. Okay, basically this is I call this the cheerleading section, right? This is where management interprets their results. Here's what we did, and we did great, right? Our financial condition is it's solid, and going forward, we think we're going to do even better. So basically, the MD&A is management kind of reflecting on their performance, interpreting their performance, and their financial condition, and also providing some opinions, not fact, it's opinions on what the company thinks is going to happen next. How do we think we're going to perform in the coming year? Oh, we're going to do great, right? We're going to knock it out of the park, okay? That's one section of the annual report. Next section of the annual report is the the notes to the financial statement, right? We'll learn about this as we keep going, as we keep going through the next 7 weeks. But basically, what the notes to the financial statement are is they hold information that says, here's the assumptions that we made based on certain calculations. Here's the measurement procedure that we used. Basically, the notes to the financial statement give us the information behind the numbers. How did you end up with this number? Well, I made a few assumptions. I had to estimate a few things, and here's the measurement procedure that I used. Okay, and then finally, this is a big one. It's an auditor report, right? Basically, this is a report from a third-party independent auditor that basically states an opinion regarding the financial statements. Now, the auditor's report, or the auditor's opinion, I guess I should say. Yeah, the auditor report, which states the auditor's opinion, does not specify, hey, this company's great, or hey, this company's sound, right? Doesn't do none of that. What they do, or what the auditors do, is they go through the financial records, they conduct an audit, and they give an opinion based on, did the company follow GAAP, right? And you'll see a lot of reports. If you're, again, accounting major, you'll get into this in your auditing class, excuse me. But there's a number, I think there's 4, I believe there's 4 opinions if I'm remembering correctly, okay? There's no misstatement. It's a clean report, meaning that, hey, this company followed GAAP, right? And basically there's reports that say, I don't know what this company did, but they didn't follow GAAP. So the opinion is in regards to, were the financial statements prepared in accordance with generally accepted accounting principles? So basically the auditor says, hey, in our opinion, these financial statements are represent, or the company followed generally accepted accounting principles. That's all they're given an opinion on. They're also given an opinion on the internal reporting, or the internal control process of the company. Again, they're not saying the internal control process is good or bad. They're saying that, yep, they instituted an internal control process. We audited it. If there's any breakdowns, their internal control should catch any breakdowns, okay? So keep in mind, an auditing report is not looking for fraud, okay? Basically, you're going to find fraud by accident, not intentionally, okay? You're not going to go out and seek to identify fraud. It's not going to happen. Too much to look at, right? So basically we're saying, hey, these financial statements are in accordance with generally accepted accounting principles. That's our opinion. Do with the information as you will, Okay. Describing careers in accounting, right? Well, there's a number of things we can do in accounting, right? We can do private accounting, okay? Meaning we can become an analyst, right? We can become an internal auditor. We can be a tax accountant for a specific company. We can be a cost accountant, right? Or we can go the public route, meaning we can offer our services to the general public. We can audit company records. We can prepare tax reports, or I'm sorry, we can prepare tax filings for corporations and individuals. And also we can offer consulting services. Hey, here's how you should record your books. Here's how you should maintain your books. Here's how you should record this entry. Here's how you should record that entry. Okay. And then finally, we have government accounting, right? We can get into government taxes, government audits. We can get into budgeting. We can get a criminal investigation. So maybe we could go into forensic accounting. I'm not at this stage in the game. I'm not going to get into the conceptual framework yet. Okay. What we're going to do is we're going to pepper in this conceptual framework as we go through the course. Okay. I think there's a lot here, especially in chapter 2. Chapter 2, we're going to get into our debits and credits, and I don't want to overload you. Okay. Like I said, this conceptual framework, this FASB gap, we'll pepper it in as we go. Okay. So thanks for tuning in, and we'll see you in our next video.